Canada created 90,000 new jobs in April, according to StatCan, which sounds like good news. But as always, when you dig into the rest of the numbers, it turns out it's actually not good news again. But also, could Canadian consumers benefit from longer-term fixed-rate mortgages like 10 years or even 25 to 30 years like they have in the US? That's the question asked in a new report from Desjardins Financial, and the answer is, yeah, probably, right? That's right, folks, it's time for another Saturday Friday update with your old pal, Millennial Moron. I've got 4 stories for you this week, and it's going to be a little quicker than normal because I'm trying to work on some other long-form content, along with some other off-channel podcasts and interviews and stuff. This is a one-person operation, cut me some friggin' slack here. First up, Desjardins recently released a report on the idea of 10-year fixed mortgages in Canada, and their analysis concluded that if we had longer-term fixed mortgages in Canada, it would have reduced our sensitivity to interest rate shocks compared to the system we have currently. Now, as a math enthusiast, I don't usually like to say this sort of thing, but yeah, you didn't really need to do an analysis to show that. It's pretty obvious. However, this is still making the rounds in the news as though it's a new idea, so I want to take a moment to address a question I get asked pretty frequently, which is, why don't we have 25 and 30-year fixed-rate mortgages like they do in the US? The answer, as far as I can tell, lies in the Interest Rate Act. Section 10, subsection 1 limits the amount of penalty that can be charged for prepayment after 5 years have passed. So basically, once you've held a mortgage for 5 years, the banks can only charge you 3 months interest if you want to break the mortgage to go with another lender for a lower interest rate. And as we know, Canadian banks are not in the business of taking risks or losing money. That means the banks essentially have no incentive to offer competitive rates on mortgage terms longer than 5 years, which is why if you do find a mortgage term longer than 5 years, there tends to be a big premium on the interest rate versus what you can get with 5 years or less. So if we want longer fixed-rate mortgages, we'd most likely need to change the Interest Act to allow penalties on prepaying debt beyond 5 years, otherwise nobody is likely to offer that kind of product at a competitive rate. Next, StatCan released the Labour Force Survey for April, and Canada added 90,000 jobs last month, with about 40,000 being full-time and 50,000 being part-time. This is actually quite a large increase for a single month. In comparison, we added 350,000 jobs in all of 2023 combined. However, despite this unexpectedly large number of new jobs, the unemployment rate stayed flat at 6.1%. This is because we're on the same trend as previous months in terms of the size of the labor force. The working age population grew by 112,000 people in April, with the labor force growing by 107,000, so while we added 90,000 jobs, we still ended the month with 17,000 more unemployed people in the country. In National Bank Financial's economic update for May, they published this chart showing that in the past couple of years, the rate of departures and layoffs has crept up slightly, while the rate of unemployed people who are finding jobs has plummeted. They also had this interesting chart, which shows that while unemployment has continued to rise, the percentage of companies self-reporting labor shortages has fallen significantly below the long-term average, which I think further erodes the idea that we're somehow currently facing an unusual labor shortage. It also provides some interesting historical context. Even at the height of our labor shortage panic a couple of years ago, this was still in the range of 40 to 50% of companies, which up until the 2008 financial crisis was a perfectly normal amount. Personally, I think this bolsters my hypothesis that after 2008, companies had such an easy time finding and hiring people that they lost the skill set of attracting, training, and retaining workers over the long term, and are turning to highly exploitable labor sources like the Temporary Foreign Worker Program to eliminate the need to compete with each other for labor. As an aside, every time I talk about this, I get a flood of comments about how this is liberal immigration policy flooding the country with workers. But this pattern of claiming a labor shortage and then using it to supply companies with low-cost foreign labor is nothing new, and while the current Liberal government is absolutely complicit in abusing these programs to exploit foreign labor, it's not exclusive to the Liberals by any means. This paper from the School of Public Policy at the University of Calgary, written all the way back in 2013, goes into a very similar discussion to the one we're having today. It discusses how the Temporary Foreign Worker Program had been rapidly expanded over the previous years, how companies were very obviously using the program to avoid hiring from the existing domestic labor force, and how the program was being used to fill jobs even in areas with high unemployment rates, despite claims of a labor shortage. And keep in mind, this was happening in the aftermath of the 2008 financial crisis, and the number of companies reporting labor shortage issues was only 20%, well below the long-term average. This paper from the University of Waterloo shows the size of the program more or less doubled immediately when the Conservatives were elected in 2006, and carried on at that pace even in the aftermath of 2008 when unemployment rates were still very high. Now, back in 2014, the Temporary Foreign Worker Program was split into 2 programs, the TFW program and the International Mobility Program. The IMP is a lot like the TFW program, except it covers workers from countries who we have a reciprocal agreement with, and it doesn't require a labor market assessment to hire someone through that stream. Well, we can see that after the Liberals were elected in 2015, they did actually reduce the size of the TFW program, which is something they campaigned on 10 years ago in the lead up to the election. The reduction in the TFW program was more than made up for by an increase in the International Mobility Program, where employers don't even have to demonstrate that they've made an effort to hire a domestic employee. Again, none of this is to try to influence you to vote one way or the other. I'm just saying that if this is an important issue to you, it won't be solved by just voting. You need to actually pay attention to what happens after the election and hold your own party accountable instead of just saying that the other guys would have been worse. It's pretty clear that both parties are using these programs to inject cheap labor into the market for short-term economic boosts, but it's causing serious issues in the longer term. Next, Calgary City Council passed a citywide rezoning bylaw on Tuesday after a marathon public hearing lasting 16 days and featuring over 700 presentations from speakers who showed up to provide input. The new bylaw increases the base residential district in the city to a zone called RCG, which would allow more low-density housing forms, up to row housing, to be built anywhere after the development permit process, eliminating several months and the associated rezoning cost from the home building process. I've been covering Calgary's affordable housing plan for the past year, and while this is only one item out of almost 100 recommendations in the plan, it was by far the most controversial, with a lot of people wanting to preserve neighborhoods with exclusively single-family zoning. Personally, I think it's a good idea that will allow gradual redevelopment into slightly higher density instead of eventual redevelopment in older neighborhoods taking the form of multi-million-dollar detached infills, as we've seen in cities like Toronto and Vancouver, who were very slow to modify zoning bylaws as the city expanded. In fact, Vancouver, which is one of the least affordable cities in the world for housing, had more of the city's zone for single detached housing than Calgary did, despite having a higher population and a smaller footprint. Obviously, this rezoning is not a solution to the housing issue on its own, but to me it seems like a good move in the long term, which will allow more gradual market-based densification over the coming decades, rather than having the city government try to centrally plan what happens on every single parcel of land. Still, it remains to be seen what will happen with the other items in the housing plan, including affordable housing incentives that could be used in combination with the new zoning bylaw to enable different housing forms, like co-op developments. Finally, data from StatCan shows that our household debt service ratio, which is the amount of disposable income used for debt payments, has risen to 15%, close to the peak over the last 35 years. Notably, since the rate hike started in 2022, the total debt service ratio has risen from 13.55% to 15%, an increase of 145 basis points, while the interest-only portion has risen from 5.86% to 9.16%, an increase of 330 basis points. This means that we're not just paying a larger portion of our household income towards our debts, but more money is going to interest and less money is going to actually paying down the balance of those loans. On a personal note, this is one of the big problems that I've been concerned about as I've watched it build up over the past 10 or 12 years. As interest rates fell, we kept taking on more and more debt as we bid up the price of housing, while incomes remained relatively stagnant. The worry for me was what would happen when interest rates inevitably started to rise again, and now that they have, it seems like we're starting to finally feel the hangover from all that debt. With all these effects converging at once, we're seeing reports coming out that we're on track for the largest and longest decline in our standard of living in 40 years, if not more. If you believe any of the projections I've been showing from economists in previous videos, it could continue to get even worse in the coming years. A lot of people ask me what they should do about this kind of thing, and to be honest, I don't have any magic money strategies for you. My advice would be to prepare yourself financially as much as possible, but more importantly, try to build up your relationships with friends, family, and loved ones. Because unless you're already fairly wealthy, that's what's going to help you to weather difficult economic times, having a community that can support each other both practically and emotionally. And even if I'm wrong and things turn around and start going great for everyone, you're not going to regret having better relationships with the people around you. You might even find out that money isn't as important as you thought. Anyway, that's all for this week, so as always, thanks for watching and enjoy the long weekend.